Welcome back to the channel, and as always, if you copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to look today at a stock called AMN Healthcare Services, ticker AMN. This is a mid-cap stock with 2 billion market cap, unusual profile for the type of stocks we normally look at for shorts. That's the kind of play that I have here. And in this particular market that uh, we're in now, I'm not necessarily looking to go short defensive play, a defensive kind of stock. However, I think this is a stock that is going to remain subdued for quite some time. Let's have a look at. So the company mostly provides traveling nurse services. If I go here to the description, you'll be able to take a close look what they do. So workforce and staffing services to healthcare facilities in the United States. It operates through three segments: nurse and allied solutions, which is the largest, is uh, like 75, more than 75% of the revenues. Then physician and leadership solutions, that's about 13% of revenue, and technology and workforce solutions, that's about 10%. And those latter two are really a support function of the previous one. So this is a stock that actually did pretty well in previous years. So if we go to the actuals and consensus, you can see that in 2022, the company EPS was way higher than what we saw back last year. And it's also continuing this trend of deceleration in terms of EPS. Now, for the next years after this, the company is expecting a moderate increase back after 2024, but it will still be below these 8.21 level that we see here for the 2 or 3 years next to come. So I don't expect this stock to rally necessarily. At the same time, it's arguably a sector that has been in decline for some time. So what happened was you had COVID, and let's have a look at the chart and a longer time frame to see that. So you had COVID, right, with the initial shock, and then the stock went up quite a bit because the traveling nurse service that they provide was in very high demand. People could not necessarily walk into places to get the healthcare treatment that they wanted. But with the end of lockdowns, that's come to an end, and so the demand for these traveling nurse services has been eroded. At the same time, we are experiencing in general in the healthcare sector high levels of demand for qualified medical staff, which, as per the commentary that we have seen in the ISM service, point at challenged inflationary pressures through labor and service cost increases. So it sounds like the there is a lack of supply of qualified medical staff and high demand at the same time. And what I feel is happening is that this end of the market is not as lucrative as it used to be, and it's likely going to be a problem for these organizations to uh, to drive that margin expansion. And that's something that we can see here if we take a closer look at the quarterly performance. So, for example, uh, you can see how gross profit has dropped quite a bit over the last few quarters. It keeps going down quarter on quarter. And as a matter of fact, it's expected to continue to erode quite big, actually, with moderate recovery projections at the end of the year. Same thing goes for the EBITDA, where the pictures are even more bleak. Uh, EBIT, similar kind of picture. Net income. So as you can see, the projections are not great for this company. Now, management has been quite upfront, and that is something that, to me, lessens the blow of how dramatic a drop in the stock price can be. So, for example, uh, they announced during the last earnings call that they're seeing healthy trends in some key businesses, but that is overshadowed by weaker demand and a continued competitive environment in their largest business, which is nurse staffing. So overall, they've been quite upfront about the situation and how they are addressing it. As a matter of fact, even though the EPS in the latest earnings report it wasn't the worst. So sales was okay, as you can see here. EBITDA exceeded, EBIT slightly down, but EPS was okay, and EPS gap was also exceeded. The problem, though, was the guidance that they provided. The guidance was pretty mediocre. Excuse me, pretty mediocre with low revenues and also eroding margins. And so the guidance for the rest of the year was dropped, was downgraded. So the main challenges that they pointed at these decreasing margins was that the growth of lower margin locum revenue and lower nurse staffing margins. So that change was offset in part by revenue mix shift towards higher margin segments, right? So we have to ask ourselves, is this situation, which has been taking place for quite some time, going to continue? Well, I think it will continue. It's hard to say at this stage if it's going to get worse, because it's been the case for quite some time. So I'm not necessarily expecting a massive drop here, but I think it can happen over time for a number of reasons. First, because of the downgrade in guidance, what we can see is that the valuation went from 15 to 18 rather rapidly, and it's been stumbling down ever since. If we compare that in the record of history and see where we are now, this is not a very low multiple that we're sitting at, and there's been plenty of times in history where the valuation has stayed around or above these levels. At the same time, what we could be seeing as well is a return to these previous levels that we saw at the beginning of the year of around 15 times. So if we take the current EPS and for the next 12 months, the PE for the next 12 months, so let's divide that by 18.1 and multiply that 15. So 15.94 current price divided 18.1 times 15. So that would give us a price of around $46. Uh, that's, I think, around a 10% move. So at this point, and having seen how the stock has decreased quite a bit over the last few weeks, I don't think we're gonna get there anytime soon, but potentially we might at some point, say over the summer. So here's a way I'm gonna play this. So um, I could potentially just stick it on the watch list and try to enter around here, around the 60 dollar level, try to retest this SMA moving average. But at present, I want to add more shorts into my portfolio. This one, I think, could be structured quite well with a three-leg structure. So the way I would be playing that is buy the 18th October 55 puts and then sell the 19th July 55 puts as well as the 18th of October 50 puts. So essentially what we're doing, we are short a calendar spread, at least for a while, and then we're transitioning into a vertical. We get an entry credit of $70, and our maximum risk, assuming the stock hits zero, which of course is quite unlikely, it's 5 grand. So with that, um, we would want the stock to remain at 55 or above until the 19th of July. For the time being, there's no catalysts that we see before the earnings report. So I think it's possible that that happens. I run some numbers on the probabilities of that happening, and um, it's not very far-fetched. So that's the way I'm gonna play it. The company has a debt ratio of 156%, and about a third of that is a floating rate. But the company has expressed their priority of paying down some of their debt, and I think that's one of the reasons why we are not going to see uh, upside risk on this stock for the time being because they're just focusing on taking that cash flow and servicing the debt. Um, and in terms of risks, the earnings yield at the moment is 6.18%, which is not bad compared to treasuries. Obviously, that earnings yield will get better as the stock goes down. So this could be uh, a limiting factor in terms of the downside risk that we see in this stock. And that's part of the reason why I would be structuring the trading this way, waiting for that earnings report to come out. So that's it for today. I hope you enjoyed the video. Subscribe and see you soon.